I've watched coaches sign master service agreements without reading them because they wanted the engagement and didn't want to seem difficult. Some of them agreed to unlimited intellectual property assignment, 3-year non-competes with every company in the client's industry, or clauses making any content they produce the client's property. Those clauses are in real MSAs. None of them are standard. All of them are negotiable. The problem is you can't negotiate a clause you didn't notice. Here's a pattern I've seen coaches repeat. Sign MSAs without reading them because they wanted the engagement and didn't want to seem difficult. Here's what some of them agreed to. Unlimited intellectual property assignment. A 3-year non-compete with every company in the client's industry. A covenant that any coaching content they produce becomes the client's property. Those clauses are in real MSAs. None of them are standard. All of them are negotiable. The problem is you can't negotiate a clause you didn't notice. You can review a 40-page MSA in 90 minutes if you know what to find. 5 clauses. IP ownership and assignment. What work product the client claims. Exclusivity and non-compete scope. What you can do for other clients. Indemnification and liability cap. How much exposure you're carrying. Confidentiality scope and duration. What you can't say and for how long. Termination notice and payment terms. How the engagement ends. Find these 5. Everything else is standard boilerplate. Here's what to look for in each. IP assignment. Many templates assign all work product to the client. Limit this to deliverables produced specifically and exclusively for this engagement. Your core methodology, your frameworks, your assessment instruments are not in scope. Most legal teams accept that language without escalating. You have to ask. Non-compete. Get it scoped narrowly to the specific coachee's team, not the whole industry. Indemnification. Look for caps that match your coverage. Uncapped indemnification is a risk you can't carry without insurance backing it. Confidentiality. 2 years is standard. 5+ is unusual and worth a conversation. Termination. 30 days, mutual. Both parties, not just them. 3 insurance products. All 3 matter for enterprise work. Errors and omissions, also called professional liability. This is the one that covers claims about the quality of your coaching. General liability covers physical location incidents. Cyber liability covers data breach scenarios if you're storing client materials digitally. Which carrier and which coverage tier depends on the engagement type. And that's the next slide. A brief note. This video is operator-level guidance, not legal or insurance advice. Consult your carrier and attorney for your specific situation. The 2-tier insurance landscape, and why it's the load-bearing teaching in this unit. Tier 1 is vanilla solo coverage. ICF affiliate policies like Westminster Global, Insurance Canopy, Hiscox, Next. E&O limits in the $1 to $2 million range, roughly $140 to $500 a year, appropriate for direct pay individual clients. Tier 2 is subprime contractor coverage, commercial carriers like the Hartford and similar. E&O aggregate in the $5 million plus range, required when a prime contract MSA imposes flow-down liability requirements. Multiple times the cost of Tier 1. The decision point? Read the MSA's insurance schedule before you sign it, not after the COI request arrives. Here's the scenario that makes this concrete. A coach wins an engagement routed through a federal prime contractor. The prime sends the MSA. The coach finds the 5 clauses. They all look fine, and signs. 6 weeks later, the prime's program manager sends a COI request. The prime's insurance exhibit requires $5 million E&O aggregate workers' comp and a named additional insured rider. The coach has a Westminster Global ICF affiliate policy at $1 million aggregate. Gap is $4 million. Options at that point: go back and negotiate the minimums down. Sometimes works, especially if the prime said the template without checking the actual scope. Buy up, find a commercial carrier, go through underwriting, wait for the policy to bind, or lose the engagement. 1 hour of reading before signing prevents all 3 of those options from becoming emergency decisions. That's not procurement paranoia. That's reading the document you're about to commit to. A certificate of insurance is not the same as insurance. It's a document from your carrier that proves your coverage exists and names the client as additional insured. It does not generate automatically. You request it specifically from your carrier each time a new client requires it. Email your carrier, name the client as additional insured. They issue the document. You forward it. Here's the version of that story that goes wrong. A coach avoided getting COIs because she'd never been asked for one. Then she won a mid-market RFP that required a COI naming the client within 5 business days of contract execution. She didn't have E&O at all. There's typically a 30-day waiting period before E&O coverage activates. She almost lost the engagement. Get the insurance stack before you need the COI. The engagement you just won is the worst time to discover you don't have coverage. The mistake embedded in how coaches think about insurance. It's a year 1 decision, not an ongoing one. The tier of coverage required is not fixed. It follows the engagement type. A coaching practice that adds its first prime contract or federal client without reevaluating coverage is operating with an unexamined gap. The right trigger for reevaluating insurance isn't the calendar. It's every new enterprise or platform engagement. We're naming the Hartford as our Tier 2 carrier example because Tandem holds that coverage for our subprime contractor work. We're not publishing our premium figures, and we want you to notice that move. The teaching is the decision logic, not the dollar amount. The MSA review checklist ships with this unit. Here's the practice step. Get the sanitized MSA template from the resource pack. Practice finding each of the 5 clauses, including the insurance schedule exhibit, which is usually at the back as an appendix. Then compare the exhibit's coverage minimums against what your carrier currently provides. Do this once before you're in a live negotiation. The muscle memory matters. If you have a prior MSA from an enterprise or platform engagement, pull it now. Find the insurance requirements section. Compare it against what your carrier has on file. That's the exercise. RFPs and MSAs are the direct entry process for B2B coaching. But there's a second path that some coaches are told is the easy route, getting on a platform roster. BetterUp, Coach Hub, Ezra, Sounding Board. Before you apply to any of them, here's how to actually evaluate the opportunity, because the decision deserves more than a vibes-based yes. That's Unit 6.3.